Hi folks, welcome to this video for a different version of the quiz. In this case, what you'll see is that we still have the situation with little and big. Little is the customer who has the account payable. They can't pay big. So big agreed to substitute a 1-year note, which again, 1 year means it's short term. And for the receivable, the open account receivable, little agreed to the following option presented by big. Okay, a 1-year non-interest bearing note. You remember in the first example, we had an interest bearing note. Now we have a 1-year or short-term non-interest bearing note. And you'll remember for any note that's non-interest bearing, any interest that we might accrue is going to go into the note receivable. There is no interest receivable account. And it tells you that we're making the note for $113,400, or that being the amount that little is going to have to pay back to big at the end of the year. And that means we've implied an interest rate of 8%. So when you take 8% multiplied by 105,000, that will give you the amount of interest that's included in this 113,400. It's a short-term note, so we can do it that way. Now, to make the entries, again, on Big's book, so Big has the receivable, we're going to set up the note receivable and credit the account receivable for 105,000. Remember, the note receivable is going to grow by the amount of interest that we debit directly to the note receivable over the 1-year period. So in this case, what do we have? We set up our note at 105. Why? Because the amount of the account receivable that little owed to Big was 105,000. That is now going away on Big's books, and we're substituting the note. At the end of December, we're going to debit the note, again because it's non-interest bearing, for the amount of the note, interest receivable on the note. So we debit the note receivable for how much? 8% on 105,000 for 3 months, October, November, December, is 2,100. Now on September the 30th, what are we going to do? You can set up the entry in a couple of different ways. Some students might say, well, I'm going to record my interest on the note, which gets debited directly to the note receivable. Why? Because it's non-interest bearing. We know the implied rate of interest is 8%. From January to September 2015, that's 9 months, on a $105,000 note, that's $6,300 of interest that gets debited to the note, and we're going to credit our interest revenue or interest income for $6,300. Now what happens? If you take the opening value for the note and increase it by 2,100 and 6,300, you'll see that if you add together these three debits, you're going to have the note at 113,400. So all we're going to do now at the date that little pays Big, we're going to, as Big, debit cash and credit the note for the amount of the note, which is sitting at 105 plus 2,100 plus 6,300, 113,400. So we debit cash and credit the note for 113,400. Now, some students might do is they might do a little bit differently. Some students might say, well, we know that we have here at December 30th or September 30th, 2015, when the note is paid up, Big receives cash of 113,400. We know this because that's in our question. How much interest income or interest revenue did we book over the 9-month period from January 1st to September 30th, 2015? That's our $6,300. So some students might put that here and say, well, now we're going to reduce the note receivable by 107,100. So again, some students, what they would do is they would say, well, I had 105 here plus 2,100. I'm now going to do these entries here as one big compound entry and credit the note receivable for 107,100, which is 105 plus 2,100. So some students, instead of setting up the interest within the note and crediting the interest income as a separate entry, they might combine it as one entry and then just credit the note receivable for the amount of the debits from September and December 2014, which would have been 105 and 2100, which is 107,100. Again, this might be easier for some students to see if we set up a T account. Okay, so if we did that, we'll just underline this little guy here, and then we'll just insert another line here, and we can see at the beginning we had a note of 105,000, right? That was at the beginning when we made the note. Just try and straighten this line up here, right? This was at the beginning right here, and then at December 31st we also debited the note for 2,100. So let's now go down here, 2,100. So now if you looked at this way, you would see that your note totals here 107, 100. So what some students might say, and it would be quite correct to do, is they might say at September the 30th, 2015, I'm just going to remove the note at 107, which is its balance here, record my interest income for the 9-month period from January 2015 to September 30th, 2015, and debit cash because that's the amount of cash that Little would have given to Big at September 30th, 2015, according to the term of the note. So this concludes our discussion on non-interest bearing short-term notes. I hope you found it helpful.